Happy summer, everyone. Rob and I just wanted to send a quick video out to all of our advisory clients to give you an update as to what's going on inside of your client portfolios, what we foresee happening in the second half of the year, since the first half of the year has been so extremely volatile. It has been a historic last 6 months because there's been very few years in history where both the stock market and the bond market are down by this magnitude within a 6-month period of time. Now, the stock market's down about 23% year to date, but the more painful part is the bond market's down about 12% during the same year. And normally, as most investors know, usually when the stock market's down, the bond market is up. That just hasn't happened this year. In response to the heightened level of volatility in the markets, we've made a lot more changes to client accounts than we do in most traditional years. You've seen a lot of trades come through, and we started this activity back in November, December last year. So a lot of these moves have worked out to the benefit of our clients. We've been moving a lot more money from stocks into cash and bonds into cash. Right now, across all of our client portfolios, the range is about 30 to 40% in cash in most of our client accounts, which is the highest percentage we've had in cash since 08-09. So that kind of speaks to our defensive posture within client accounts when both stocks and bonds are selling off in tandem. The other thing we've done within the stock piece of the portfolio is we've shifted a large percentage from large cap growth to large cap value, large cap growth being where a lot of the tech sector is, and that's gotten hit even harder than the broader market this year. Within the fixed income side of the portfolio, it's really been moving away from our high quality investment grade intermediate term bonds, which are those bonds that are down 12%, shifting them more to cash, and also a shift to short term bonds, which keep renewing at the higher rates, and inflation protected bonds, which tend to hold up better in inflationary environments. Now let's talk about our outlook for the markets for the second half of the year. Now, going into this year, we expected inflation to be the biggest risk of the markets, and unfortunately, that risk has not disappointed. We're still humming at 8.5% year over year inflationary growth, which is way too much for the market to take over the long term. By now, it was expected that these inflationary pressures would be subsiding, but they're not. They're sustaining at these higher levels, and at some point, it's going to hit the consumer, and we're already starting to see evidence of this now. A few weeks ago, Walmart, Target announced their corporate earnings, and they said, hey, just so everyone knows, the consumer is buying less, and we can see them trading down from name brand items to generic brand items to help save money. That's one of these canary in the coal mines for the consumer that says, yes, the consumer's been strong up to this point, but they're starting to break, which is key for the economy. While everyone's looking for a peak in inflation, our investment thesis is it's not about the peak, it's how quickly we can get inflation to get down to a safe level. And right now, a safe level for us is something below 6% within the next few months, which is actually kind of a leap from where we are now. We say 6% because we need inflation to get below the annual wage growth number. If people are making more and they can afford the higher prices, great. It doesn't slow things down. And wage growth right now is around 6.5%. So we need inflation to be under that level. And I say that seems like it's a tall order to fill because I was just talking to a client yesterday and they said, hey, Mike, I just got noticed that my rent's going up by 24% starting next month. And when you think about someone's rent going up by 24%, that's a 1-year lease. So it's going to be higher by 24% for next 12 months, regardless of what happens with oil prices and inflation. And you're seeing this with groceries and gas and everything up. It's not going up by just 8.5%. It seems to be going up by more. So that's where we lack some of that confidence to say that we're going to see meaningful advances in the inflation rate coming down, which would then give us enough relief to say, hey, we can start coming out of cash. That's the reason why we have so much cash is we have to see the evidence first that we're making progress. There are 3 elements that need to improve in the second half of the year in order for inflation to come down. The first is supply chain, the second is the price of oil, and the third is wage growth. So with supply chain, that's going to take some time. That probably is starting to heal and improve as time goes on. There should be hopefully less COVID shutdowns out of China that kind of disrupted things in the first half of the year. So we should see improvement there. The price of oil, that's being driven largely by the Russia-Ukraine conflict. And who knows the timeline on that? It was expected at the beginning of the year that mighty Russia against tiny Ukraine, this is going to be over quickly no matter how it plays out. And that hasn't been the case. So as long as there's that disruption disruption in Russia oil. It'll probably keep the price of oil over $100 a barrel. And even if it does come down, even if it does come below $100 a barrel, we're not going to necessarily cheer, because it could be because the global economy is slowing down and demand is drying up. So we have to make sure when oil comes down, it's for the right reasons. And we don't see that meaningful improvement until we get that peace agreement, which the timeline is murky. Now, the big third one, which I believe is trickier, and we talked about this in the last video we released, which is the wage growth aspect. So wage growth, which can fuel inflation, is very sticky. So wage growth, we've got 11 million job openings and 6 million unemployed people. So that means there's 5 million more jobs than there are people looking for work. So if you employed everybody in the economy, you still have 5 million jobs. So supply and demand says if there's not enough workers and there's more jobs, wage growth is going to keep going up. And when you think about it, if I switch jobs and I make another $10,000, $20,000 per year, that means I can pay higher prices this year and next year, the year after. It doesn't go away just because oil prices went down or the Fed raises rates. So we look at that and saying, in order to solve that wage growth problem, they got to get rid of those 5 million excess jobs, which means they have to slow down the economy by enough that companies turn around and say, hey, we don't need those people anymore, which isn't the best market scenario. There is another rule in the markets that seems to be true across history, which is don't fight the Fed, which means when the Fed is raising interest rates, they are intentionally trying to slow down the economy. So it's really difficult for the stock market to surprise the upside when the Fed is intentionally trying to slow things down. When they raise interest rates, it makes mortgages more expensive, car loans more expensive. So they're intentionally trying to slow down the consumer so price pressure does not get out of control. It's historically, when they start to make the turn, when the Fed is on the later end of their rate hike cycle and they're going to stop raising rates, that is usually the time we're moving back into the equities, because now they're going to start lowering rates and breathing more oxygen in the economy. Now, we can look back in history at different Fed cycles and say, hey, the past few cycles when the Fed started raising rates, the market did okay. That may be true, but they were raising at quarter point increments. The Fed just raised rates at 3/4 of a point. So they're moving 3 times as fast as they have in history. So that means they're hitting that brake pedal harder, which means it could affect the stock market differently than it has in the past. It's for all these reasons that we have these defensive positions in client accounts, and we're urging clients not to be too opportunistic here. I know the rule is buy low, but sometimes when these inflationary situations have to play out, the market could go lower first before you start to see that rebound. And I remind people that, in the past few downturns or recessions, the government has always been able to come to our aid. This was like the housing crisis. The government took all those mortgages from the banks and printed a ton of money. COVID, they printed $7 trillion to get the economy going. This inflation scenario is the only scenario that the government cannot print money to help us. They made that mistake in the 70s. In the 70s, which was the last big inflationary environment, they said, oh, people are getting hurt by inflation. Let's just give them more money to pay for groceries and higher gas prices. And they learned the hard way. That just creates more inflation. So hopefully they've learned from their past mistakes and they don't do that again. It's really that painful process of the consumer just has to purchase less. They have to take those excess jobs away. Like all these kind of slow, painful things have to happen in order to get on the other side of this inflation risk. We're also putting out this video now because we're about to enter Q2 corporate earnings season, which will start July, August, where corporations come out and say, we met expectations, we missed expectations, and we think there's higher risk that a bunch of the corporations that have not brought down their earnings expectations yet are going to have to during these summer months, which could put additional pressure on the stock market in July, August, September. So again, that's why we're positioned so defensively. And if we need to, we will continue to move more money from stocks into cash to protect client accounts. If you have any questions on your particular individual situation or portfolio, Rob and I absolutely welcome setting up a call with us to review your accounts, review the outlook, and talk about things in more detail. I hope everyone has a great summer. Thank you.